Welcome to Swing Trade Pro 2.0, the 5-step swing trading blueprint. I am Frank Ochoa, president and founder of Pivot Boss and author of the book Secrets of a Pivot Boss. And in this section, we're going to explore Step 1, risk management. Step 1, risk management is very, very important to our 5-step swing trading blueprint. In this section, you will learn how to assess your risk tolerance, how to calculate core equity, trade allocation, and max portfolio risk for various account sizes. You're also going to learn how and when to adjust your level of risk exposure to the market, and also how to use the risk management matrix, which is a powerful spreadsheet here that allows you to quickly and efficiently calculate your trade allocation and your preferred level of risk exposure for a given opportunity. So without further ado, let's go ahead and get started with Step 1, risk management. So I'm going to go ahead and start off with a quote by Mark Douglas from the book Trading in the Zone, one of my favorite trading books. It could change your trading life in just the first 15 to 20 pages, much less the rest of the book. It is a powerful, powerful book. And in this quote, you see here at the very top, if you are unable to trade without the slightest bit of emotional discomfort, specifically fear, then you have not learned how to accept the risks inherent in trading. This is a big problem because to whatever degree you haven't accepted the risk is the same degree to which you will avoid the risk. Trying to avoid something that is unavoidable will have disastrous effects on your ability to trade successfully. And again, that is a very, very powerful quote. And we start our 5-step swing trading blueprint with risk management because it is so very important. If you do not accept the risks inherent in trading, again, you will do things to your position that will inherently or inevitably lead to losing money or lost opportunity, because all of the fluctuations, all the fear, all the emotional distress that goes on inside your head between the ears will eventually lead to disastrous effects for that position or positions to come. Again, we all have to be mindful of the risk that we are taking, and we have to be comfortable with the level of risk exposure that we are taking for given opportunities. And not every opportunity is created equal. Some require a more conservative approach, some require a more aggressive entry or approach, and some are somewhere in the middle. And we're going to discuss that here in Step 1, risk management. You can see right here that we have over to the left here our various categories that we're going to jump into with regards to risk management. Equity model calculation first, trade allocation model, percent of trade allocation, we'll talk portfolio heat, and then the risk management matrix. All of these are very, very important, and it creates a very concise approach to engaging the market, selecting your risk tolerance, and going for it. So right now, let's take a look here at set your risk parameters. So Step 1 of our 5-step blueprint is risk management, wherein you'll learn how to define your personal risk parameters from trade allocation to max portfolio heat. Each trader has a different risk tolerance, and it is important that you fully understand your own risk tolerance so that you may define the risk that you are willing to take for a given opportunity. You will also learn how to navigate among various levels of risk exposure as the odds of profitability for opportunities increase or decrease. If you're someone taking notes, if you've printed out the PDF here and you're taking notes along the way, this is very, very important. You will learn how to navigate among various levels of risk exposure as the odds of profitability for opportunities increase or decrease, which means if you have great odds that something's about to go up, then you can increase your level of risk exposure. If you have poor odds that something's about to go up, then perhaps you may not enter that position, or you may enter it with a bit less risk exposure. So understanding the odds of profitability, great odds, should get a little bit more risk exposure. Poor odds should not get much risk exposure, if any at all. So again, it's up to you to work toward understanding the odds of profitability for given opportunities, and then adjusting your level of risk exposure accordingly. So really quickly, assess your risk profile here. Conservative, moderate, aggressive. Those are the main categories. You can add any category you like, but I like the idea of slow, medium, fast, something like that, right? Aggressive is someone who seeks to rapidly grow their account. They'll place directional bets under the most favorable circumstances and will increase that exposure as odds increase. So someone's very aggressive, they're going to put a little bit more money on that opportunity. Others are more moderate. A moderate trader may focus on growth of their portfolio, looks to increase and decrease risk exposure according to the odds of profitability for a given opportunity. So moderate, in that sometimes you'll push the pedal to the metal if it requires it, and sometimes you'll pull back. It all depends on what's going on in the market. And then there's a conservative approach. A conservative trader focuses on capital preservation and growth and looks to produce income trades while limiting risks. I think at our best, being able to flow seamlessly in and out of these categories, I think, is very, very important. Sometimes it's seasonality. Sometimes if you're going through summertime trading, perhaps you don't put that much risk exposure on the line. You pull back a little bit. If there's an increased volatility environment where perhaps at the beginning of the new year more traders are coming back into the game and you start to see more movement, perhaps that's a time to be more aggressive. So again, sometimes it's seasonality, sometimes it's based on the odds of profitability for a given opportunity, but being able to seamlessly flow in and out of these risk profiles, I think, is very, very important. One easy way to kind of go about this is, trade by trade. As a general rule of thumb, you may be more moderate for every single trade, and then if something really strikes your fancy, be aggressive for it. And if something doesn't, if something is good, but it's not really as great as some of the other opportunities, perhaps you go conservative. So this is kind of your midpoint, and you'll kind of drift this way for an opportunity if need be, or you'll go up here. But most of the time you may stay somewhere in here under normal circumstances. So let's progress onward to the next section here, which is equity model calculation. Now, in order to identify what our preferred trade allocation is for each trade, say, we have $50,000 account or a $100,000 account, whatever the case may be, you have to know what you're willing to bet on each trade, right? And again, that goes back to level of risk exposure. Now, in order to do that, you have to understand what your core equity is. And so before putting your money at risk, you must first outline how you intend to manage risk. In essence, you must first set your risk parameters before executing trades. In this section, you will learn how to calculate tradable equity so you can begin determining your preferred trade allocation. We will use the core equity model to calculate tradable equity. The core equity model, as you see here, the value of your account equity is determined by the amount of cash in your account less the amount allocated for each open position. That's the core equity model. Equity is only added back after closing a position. So you use this model to determine how much of your account to risk for each position. So basically, say you have a starting equity of $50,000, and then you risk $500 on the next trade, which is 1% of the account. And on that 500, while that trade 1, T1 here 500, trade 1, is in play and still playing, now if you go to take the second trade, now you're taking 1% of the remaining core equity, which is the starting balance minus any open risk position. So the risk portion of any open position. So if you're still risking 500, subtract it from the original, and now you have 49,500 to place on the next trade, or to use a percentage of that for the next trade times 1%, right? That gives you $495. That's right here for the next trade allocation. So trade 2 gets 1% of this core equity, and that's here. Now say you go on to trade 3. Well, now you've already got 500 plus 495 of risk. That's about $1,000, right? So you go down to a core equity, remaining core equity of 49,005. that means 1% of your next trade would be $490, and you would continue on in that path. So core equity is basically your total equity, all the cash, everything in there, minus the amount of risk that's allocated to each open position. Now, say you were to be in these three trades, right? This one, and this one, and then you close this one for a gain of, say, $1,000. Right? Now that 1,000 goes back into, sorry, not here, but goes back into this remaining core equity, and then from there you can use that to look at the next trade, which would be now a third trade after 2 and 3 are in. You knock that one out, and now this one's open, and maybe another one, T4 here. So basically, core equity is all the cash in your account minus any amount of risk capital for each open position. That's very important, and we will be using that in order to identify what our next trade allocation will be for the next trade. So now that we have our core equity, we're going to move on to the trade allocation model. The trade allocation determines how much you're willing to risk for a given trade. The trade allocation model that we will use is the fixed risk model, which allows traders to control position size as a percentage of core equity, right? So a fixed risk model is something that I've been using for a very long time. It's also known as the fixed fractional model. In this case, the model involves controlling position size as a percentage of core equity. So just what we did before. 1%, for example, of $50,000 was $500, right? And so that would be your trade allocation using a 1%, for example. So fixed fractional means a fraction of your account, and it's fixed, so you would use that amount each and every time, right? Now, I wanted to give you some stats here to understand trade allocation with regards to percentages, because this goes back to research that I've done over the last 15, 18 years, and then again putting this into practice in various funds and accounts, long and short-term accounts, all of it. And this is a very good synopsis of, you know, data mining, the types of data that we mined and understood and traded from. And in this book by Dr. Van Tharp, Van Tharp's Definitive Guide to Position Sizing Strategies, is a giant textbook. This gives a really good representation. It gives you a very good framework that allows you to understand the risk profiles associated with various risk percentages. So, for example, while 1% is a very standard approach, but 0.8% right here. So basically, 0.8% returned a chance of ruin of only 0.1%. Chance of ruin for his for that study was all of 20% loss of starting equity. That would be a ruin, I believe they used in that case. So you had a very small chance of ruin to go down 20% of your account on a 100K account after your first 100 trades using 0.8% fixed risk. However, there was also a 0.4% chance of reaching 300% profit objective. A 300% profit objective over the first 100 trades, basically. So again, if you don't risk much, you don't make much sometimes, right? But you're not going to break an account. That's very important. 1.2% fixed risk. Now on this one returned less than 1% chance of ruin. Again, 20% loss. But it returned an 8.5% chance of reaching 300% profit objective on the 100K account after the first 100 trades. Again, the same type of simulation. So better chances than here, and still a meager shot of ruining the account with 1.2%. Now I'll tell you right now, when we were looking at this for our last fund here, and we were doing all the numbers here, 1% trade allocation was solid. 1.5 equally solid. Once you start getting above 2% and especially 2.5%, things start to really become a little more unstable. You can make a lot more money, but you can also lose a lot more money. So if you look here at 2.6%, for example, fixed risk. This was the optimal retire/ruin ratio for the study he conducted. So based on 10,000 simulations, 10,000 100 trade simulations, this percentage returned a 54% chance of reaching 300% profit over the first 100 trades, and returned about a 12% chance of ruin. Actually, it was 25% loss, so not 20. So you can see right here, again, this right here, when you're around 1% or lower, you're safe in most cases. When you start getting around 2.5%, that's when things start to be a little bit more aggressive, right? You either have a good chance of reaching your major targets, but at the same time, your chance of ruin starts to increase as well with that position sizing. It's not horrendous, but it's very good. So this is the optimum retire-ruin ratio, as Dr. Van Tharp put it. Now let's go out here to 3.6% here. You can see 3.6% fixed risk returned the greatest probability of reaching 300% objective. So a 60% chance of reaching that 300% profit objective after the first 100 trades on the 100K account. But basically 1 in 5 chance of a 25% drawdown as well. Down here, 4.6% risk returned the highest median gain. So the highest median gain was 545% with a 58% chance of success. But look at the chance of failure, 1 in 3 almost percent chance of reaching a 25% drawdown. So I give you these stats to give you a framework, to give you a basic understanding of the various risk profiles associated with the various percentages. Again, I would stay somewhere in this zone, and we're going to look at that in a moment. Personally speaking, I go 1, 1.5, and 2.6 is generally my approach. And so I stay in this upper echelon for the most part. There are cases where you would go higher, but again, that's all dependent. We'll talk about those cases down the road. So I wanted to give you some background information with regards to trade allocation at the outset, and now we'll look at some more percentages here. Alright, so if we go down here, what you'll see now, depending on your core equity, you'll want to adjust the fixed risk model to fit your risk profile and account goals. For account sizes above 25K, look to use more of a conventional approach to the fixed risk model, which generally includes limiting position size to between 1 and 3% of core equity. That is the more conventional approach, quote unquote, a conventional approach for account sizes above 25K. Now, this becomes more important as you approach or exceed equity of 100K. So if you have accounts that are 6 figures, then you certainly want to really stick to this approach. Now, if you're below 25K, then you may want to be a bit more aggressive. So for account balances less than 25K, you can be a bit more aggressive. So let's look at a couple of ideas here. For example, here's some fixed risk models and some examples for an account above 25K and an account below 25K. And so these are the 3 types of levels of risk exposure that you may want to consider. Again, I stick to a conservative, moderate, and aggressive approach of 1, 1.5, and 2.6% of fixed risk trade allocation per trade. Now, again, based on seasonality, for example, if it's summertime trading, then you probably won't see me going aggressive too much. I may be going in somewhere in here. If it is a home run type of trade that has great odds, that I just love to trade, then you'll see me be a bit more aggressive about it. And so I'll float in and out of these sections here. Now, you can see right here, example, $150,000 account times 1.5% of core equity gives you a $2,250 trade allocation. So if you're trading a 150K account and you want to go 1.5% of fixed risk trade allocation on the next trade, you're going to be risking about $2,250, right? And that, again, is not chump change, but it is an amount that, given the size of the account, works really, really well, especially when the odds of profitability are in your favor for that opportunity. So again, with this type of account size, what we'll look at here in a moment is percent of trade allocation. We'll talk about how to break that down even further, but that would be the amount that you risk per trade based off of this allocation in that core equity of 150K. Now if you look at 25K below, for account sizes below 25K, perhaps you need to increase that a little bit, right? So say you're trading a 5K account or a 3K account or a 10K account or 15, right? Then perhaps 2.5%, 5%, and 10% are the trade allocation amounts that you could use. Again, 10% of 25K would be $2,500, which is more than the allocation here on a moderate. So you can definitely tell you have to use it very, very, you have to be judicious about it, right? You have to be cautious about using something like that. But again, there are circumstances where there are great odds of success for a trade, and when the odds are in your favor, that's when you may increase. So again, typically speaking, I wouldn't be going 10% on account size less than that, but there are times when you can, and I have, right? So I mean, it's always dependent upon the opportunity at hand. So just having a framework, and this is providing a framework here, just having a framework for how you will allocate per trade in various circumstances gives you a big leg up against the competition, and also helps improve overall consistency, efficiency, and everything. So very good way to look at it is just a plain fixed risk of core equity. Now when it gets to trade allocation in terms of identifying great odds, this is basically where you really get to the meat of things. Again, when you're looking at the odds of success for a given opportunity, if the odds of success are strong, allocate more. If the odds of success are lower, then allocate less, right? So in this section, you will learn how to increase or decrease the level of exposure to the market for a trade based on the odds of profitability for the opportunity presenting itself. Level of exposure refers to the amount of risk capital that is exposed to the market for a given opportunity. Ideally, you'll want to increase the level of exposure for opportunities with higher odds of success, and look to decrease the level of exposure for opportunities with lower odds of success. So depending on the odds of success and your desired level of exposure, you can execute entries into positions conservatively, moderately, or aggressively. So again, this ties together the risk profiles of conservative, moderate, and aggressive. It ties together the fixed fractional or fixed risk percentage approach of 1% conservative, 1.5% moderate, 2 to 3 aggressive. And now what I'm asking you to do is tie in further the odds of success for a given opportunity. So for trades with good odds of success, perhaps you go conservative. For trades with high odds of success, perhaps you go moderate. And for trades with the best odds of success, go aggressive. These are 3 different layers right now that you can overlay in order to really get a good grasp of how to allocate your equity for various trades. So again, 1% is rather conservative, 1.5% is right in the middle, 2.5% pretty aggressive. And now when you start working with the odds of success for a given opportunity, you can then tie those together. So again, that's very, very important way to go. Again, over here for an account size less than 25% and you're using 2.5, 5, and 10, again, it's the same idea. Good trades get conservative, high odds trades go moderate, and the best odds trades may be aggressive. So level of exposure, again, being able to understand the odds of profitability for a given opportunity, and then from there allocating your capital appropriately, either conservatively, moderately, or aggressively. So let's talk about percent of trade allocation. Now that we understand core equity, we understand the trade allocation model that we want to use, This is something that I call percent of trade allocation. So percent of trade allocation allows you to systematically scale into a position using a percentage of overall trade allocation. This entry allocation technique gives you a powerful approach to controlling the amount of overall trade allocation that will be exposed to the market at the outset of a trade, and then looking to reward winning trades with additional exposure. Again, depending on the odds of success for an opportunity and your desired level of exposure, you can allocate conservative, moderate, and aggressive trade allocations, but choose to scale into these positions with a bit more conservatism. I'll let you know what I mean here. For the most part, if you are going to enter a trade, say I'm going to enter a trade with 1.5% fixed risk. I think it's a high odds trade that will go higher, but maybe the market, is in the midst of a pullback, or maybe there might be, some headline risk coming out. Maybe there's something that you see ahead that makes you want to approach this a little bit more conservatively. You can do it in this way by using a percent of trade allocation. So if you are risking 1.5% for an opportunity, and say it was $22.50 like that last example, $2,250 that you're going to allocate at 1.5% of your 150K account, right? Then I don't have to allocate all of this right away. That is the most that I can allocate of risk capital to a position, but I don't have to do it right away. What if I scale in half and half? What if I get into half of that allocation right away? That would give you $1,125 of risk. And then if the trade warrants such, if the trade continues to push in your favor, then you can reward it with additional risk and add the second half of that risk at the most appropriate point, and that'll give you your full risk of $22.50. That right there would be this option here. So you have 1.5% of fixed risk. You have an option to scale into 50% of that trade, and that would be a moderate approach on a moderate fixed risk allocation. That's a moderate entry approach, right? You can also go into thirds. So say you had that $2,250 of full risk capital. You can say, hey, I don't want to get in half of that. Let's go a third of that, whatever a third risk is. And then you're like, oh, that actually looks pretty good. I'll go into another third. And then, this needs to be rewarded with the last third, and then price takes off, and now you're fully allocated at 1.5%, but you did it in thirds. Again, very, very important to understand percent of trade allocation. I think this is one of the things that can help most traders right away, whether you're experienced or not. This is a very powerful approach to entries, because say you get in with a full $2,250 risk and price goes straight down and stops you out, you're now out the entire lot of 1.5%. But if you had scaled in, say, a third size right away, and then price drops down, then you would take a hit on only a third of that risk, and you would have never gotten in the second and third legs because the trade didn't warrant it. And so anytime you stop out of a trade, you're going to stop out at a much smaller price tag than what you initially tagged as a trade allocation, right? Now, if the trade goes up in your favor, you can continue to add those thirds back and reward the winners, and now you're going to make more as the thing continues higher. So again, this is a very, very powerful way to allow you to dip the toe with a small position size, maybe a third or a half of what the original fixed risk is, and then adding the rest of those legs in case price continues to warrant such. Now, otherwise, if you stop out right away, or the trade goes against you right away, you're going to take a loss on a much smaller portion than if you would have just gotten in the entire trade, all in, max risk trade allocation, right? So again, this is a great way to look at entry allocation. Good odds trades, you may want to go 1% fixed risk, and then you can choose to scale in a third at a time, half at a time, or go all in at the initial entry. If you have a high odds trade, you may want to go moderate in terms of your approach, and you have the option to scale into a third, scale into half, or get into the entire trade allocation in one entry. And lastly, again, with the best odds trades, you can go more aggressively and then scale in a third, scale in a half, or scale in the entire trade allocation amount right at the entry. So again, being able to flow in and out of those, very, very important. I would say that volatility is very, very important with regards to understanding when increases or decreases of volatility may occur. Seasonality may be that, may be one of those times. Earnings may be one of those times. Headline risk, all those various factors. And so when you know that volatility is very, very low, perhaps that's when you want to go a little bit more conservative, maybe scale in quietly. If volatility is higher and things are moving the way you like, then perhaps you go a little bit more aggressively, scale in a little bit bigger. So again, a lot of different ways to choose to enter a trade based off of your level of risk exposure, your trade allocation, the odds of profitability for an opportunity, all those various things, blending them to provide a pretty sound approach for entries. So again, a great way to scale into trades based off your trade allocation. And again, it's another lever that you can pull and adjust in order to kind of go along this conservative, moderate, and aggressive scale. So a great way to enter trades using percent of trade allocation. Let's go down to portfolio heat. Portfolio heat, very, very important as well. In this section, you will learn how to calculate the amount of capital that is at risk for a portfolio, and this metric is called portfolio heat. Portfolio heat, or total heat, is the total amount of capital at risk for a portfolio, which includes the amount of risk for each open position. So say I have 10 open positions, each one at $1,500 of risk capital, then now I got 15K of risk, right? Total of all those open positions. And so understanding what this amount is as a percentage of your total equity is very, very important, because you don't want that percentage to be too high. So the maximum amount of capital that can be simultaneously at risk for a portfolio is max portfolio heat. Max portfolio heat is often presented as a percentage of total heat. So what this is designed to do is to limit the effects of price shocks that a portfolio can experience when leverage and exposure is high. It's designed to limit the effects of price shocks that a portfolio can experience when flash crashes occur. And the amount of portfolio heat you use should depend on the quality of the system as well, opportunities present, and the experience of the trader. So again, this is not a concrete amount that I'm going to tell you. It is a general roundabout amount, and then again, depending on the opportunities, depending on your approach, depending on your experience, you can increase or decrease that amount. So here's a look at it. In terms of max portfolio heat, what we're looking at is limiting larger accounts to about 10 to 15% max heat, lower accounts to double that, 20 to 30%. So limiting portfolio heat is extremely important, which helps to avoid ruin during flash crash events and periods of high volatility. Here's how to calculate max portfolio heat for various account sizes. So if you have an account, again, that's over 25 grand, 10 to 15% max heat is about where you want to be. If you have an account size that's smaller than 25,000, again, you could double that a bit, but you have to be more careful when you start getting way over here. Again, what this is designed to do is limit those price shocks that you would see when the market drops or when the market flash crashes. If you have a 100K account, right, and you have 25K of risk capital, you're now 25% max heat. If price were to have a flash crash event, something like what we saw from January to February of 2018, when the market just fell hard for about 6 to 8 days, that risk capital right there will wipe out a good percentage of that portfolio very, very quickly if it were much, much higher. So again, if you limit the amount of max portfolio heat to somewhere around 10 to 15%, it won't be as bad. So again, I tend to stick to about 10% of max heat for the most part. So if under the most bearish circumstances, or again, the max I could lose would be about 10% if everything went to zero at that moment. So again, understanding max portfolio heat is very, very important and a very simple way to manage the risk of your account. So right here, max heat by account size, 10 to 15% above 25K, 20 to 30% below 25K. So here's an example for something with 100K at 10% max heat. That's going to be $10,000. And now, if you look at 10,000K, like $10,000 of the max percent of this that you can use. Now, if you're using a 1.5% trade allocation model, that means that you can basically use $1,500 per trade. $1,500 per trade is your trade allocation. Now, if you go further and say, okay, what is 1,500 into 10K? Well, that tells you that you can have a max of 6 positions at once. So total number of positions, 6 positions at 1,500 would get you right around 10K. That's 6.6 positions. And so again, that's a way for you to understand how to do it. It's a very simple calculation. You're looking at what's the max amount of your total account. Take a percentage of it, like 10%, and then however you're going to trade allocate, are you going to use 1.5%, 1%, what are you using? Then you can divide by that. Sometimes, again, it won't always be 1.5. Sometimes it's 1%, sometimes it's 1.5, sometimes it's 2.6. And so each of these 3 trades would kind of add up to whatever amount, something shy of 10K. So again, a very easy and quick way to go about that portfolio heat calculation. Right here, example 2, this is for a $5,000 account. Maybe you got 5K in there and you're okay with going 20% max heat. 20% of 5K is $1,000. So again, that would be the most that you could lose if you were fully allocated is 20%. Now, of that $1,000 portfolio heat, if you were using the 5% trade allocation, that would be $250 per trade, and into 1,000, that would be 4 max positions. So if you have a 5K account, you can go to 20% max heat. If that's $1,000, then you can be in 4 simultaneous $250 trades, which again can happen easily with options and other trades. But again, very, very simple calculation and an easy way to calculate portfolio heat and max heat. Now let's talk about the risk management matrix. The risk management matrix incorporates and automates the sections that we've covered in step 1, risk management, including using core equity to calculate conservative, moderate, and aggressive trade allocations. What we're going to do here is look at and use a spreadsheet that I've created that I use every single day to quickly calculate core equity, max heat, max positions, and also what conservative, moderate, and aggressive amounts would be for a various position. So basically what it's looking at is if you have, say, a $50,000 account, you're going to go with 10% max heat. That's 5K. You can go with 10 max positions. And now in using that, it will then say, okay, what is 1% of core equity? What is 1.5% of core equity? And what is 2.6% of core equity? And these are your conservative, moderate, and max trade allocations now. So at a very quick glance, just by populating a few fields, you can understand exactly what you can risk for the next opportunity on a conservative, moderate, and aggressive level. Now, the easy thing here is just populate the yellow cells. So right here, there's a yellow cell, that's a yellow cell, that's a yellow cell. These are yellow. It's already pre-done for you in the spreadsheet, which you can download at the STP 2.0 dashboard. But this one, again, calculates everything for you, and there's much more below the fold here that we'll get to as well, and we'll jump into that here in a moment. The matrix, again, is designed to provide accuracy, speed, and efficiency in calculating trade allocations and risk management controls in real time as you trade. So again, I have this up live as I'm working with all my positions. I look to see, okay, if I'm looking at a new opportunity, I say, this is a great opportunity. I'm going to go moderate on the entry on this one. I'm going to go 1.5% full risk, and then that tells me what my amount would be. Okay, I can risk $750 for this account size, and then I say, okay, do I want to use all that at once, or do I want to get in, a third size first, or do I want to get in a half size, half position? If you go half position, of 750, then you're going to be dividing 750 by 2. If you go a third, then you're going to be dividing that by 3. And again, this spreadsheet is designed so that you don't have to do all this math on the fly. It's already done for you. So let's go ahead and jump into this spreadsheet. All right, let's take a look at the Pivot Boss Risk Management Matrix. This is the spreadsheet that I use every single day next to my trading machines. Anytime I need to know right off the bat what is a conservative, moderate, or aggressive trade allocation, I need no further than to look to this spreadsheet. Every single day, what I do is I look at the total equity for a given account. I enter it here in this yellow box. The core equity is what I have available to trade in terms of money that is not at risk, and I update that as well. And then I have my preferred max heat trade allocation. For example, I mentioned that you can go anywhere between 10 and 20% of max heat at any moment in time, depending on your preferences. In this case, 10% is the normal coming out of various low volatility type of markets, and then you can increase it up to 15 or 20% as you feel the time requires it. So in this case, any of these boxes that are yellow is where you need to put into the spreadsheet to reflect your risk tolerance. In this case, the 1.5, and 2.6% allocations is what I use, typically speaking, for any account that's over $25,000. So you can see there's two tabs to this spreadsheet. One is above 25K and one is below. The one that's above, if you have, say, a $120,000 account and you haven't taken any trades yet, then the core equity would also be 120. You can see that with 10% of the account in terms of max heat, that means that you can have $12,000 at risk at any one time. And if you are using the 1.5% moderate fixed risk model as your main trades, for example, trade allocation, then it would be 6 positions would go into 12K. So you can have 6 simultaneous positions at that allocation. The current heat would tell you how much you do have at risk at the moment. Current heat percentage would be a percentage that you have at risk of the available max. The available heat would be however much that you can still put at risk. And then the total exposure is how much do you have at risk as a percentage of overall total equity. So those are very, very important to know and understand. Again, you put in 3 different figures here. What's your total, what's your core, and then what's your max heat. Now this one you wouldn't have to touch very, very often. So these are the 2 that I work with every single day. Over here, I keep it at 1, 1.5, 2.6 for my liking. If you want to use, say, 0.5%, 0.75, and 1.25, that could be it too. You can use 5, 10, and 15 if you wanted to, if you had a smaller account. So if you look over here at risk management below 25K, so for example, if you had a 5K account, this is what it could look like. With a 5K account, if you haven't taken any trades yet, you'd have 5K total equity, 5K core equity. Say you have 20% max heat because it is an account over rather less than 25K, so you may want to risk a little bit more to make a little bit more. That means you would risk $1,000 at any one time. And if you, again, are using, say, 5% of account as a moderate entry, you're risking $250 per trade. Times 4 would give you your would give you your $1,000. So that's your max heat. Max positions would be 4. Your current heat percentage, all that would be filled in once you start taking trades. So let's take some trades here and let's see. So say number 1, you take your first trade and say it is $1,800. Alright, so basically what we're going to do is subtract $1,800 from the 120. If we take one trade that is a moderate risk, we now have $1,800 at risk, and then we subtract it from the core equity here. So that would give us $118,200. And now you can see here that of the available 12K heat, we currently have $1,800 at risk. That is 15% of available heat. You can see we have $10,200 still left to be able to risk, and total exposure of overall account is 1.5%. Say we take another 2 or 3 trades. Say we take 2 more trades and now we have 3 total. And now you can see that the percentages have gone down. It's no longer $1,800. So maybe say we take one aggressive trade, and that's a $3,000 trade. So now we have taken, say, $3,000, and we subtract that away from the $118,200. That gives us $115,200. So let's put that here, $115,200. And now you can see that we now have $4,800 at risk. That's 40% of the max available heat that we can put at risk. The available heat left is 7,200. So basically, if we wanted 2 more aggressive trades, we would only be able to do 200 and maybe 1 conservative at that, and that would give us 3 trades. Say we wanted to do 3 more conservative trades, that's 1,100, right? Then you would subtract, say, 3,600 from this 72. So again, that is how you can do that. So right now we're at 4% exposed overall in terms of overall total equity at this allocation. So again, let's add a couple of more trades to this. Let's say we do another trade that's $1,700 right here. And so basically we would subtract $1,700 from the $115,200. So say $1,700 here, that's $113,500. So let's go $113,500. So again, after each trade that you would take, you would just come over here and you would update your core equity. Now, in terms of total equity, I update that at the end of the day or at the beginning of the morning, so that for one time that day it is updated and now it's done the rest of the day. So usually it's at the end of the day. What's the closing total equity? I put that in there at the end of the day, and then I don't touch it again until the next day at that point where the total equity is what it is. You can update it after each trade as well. But again, during the market, it's going to go up and down as the market goes up and down. So usually one time for the day, I'm done with that. In terms of core equity, I will update that as each trade is taken. So whenever that is, I take a new trade, I update the core equity, and it gives me my new stats. Now, at $113,500, you can see we have $6,500 at risk of a max 12K that we can risk. Right? That's the 10%. Now, keep in mind that of the 6,500, right, that's at risk, that's only 54%, so we still have 5,500 left that we can risk. And so far at this allocation, we're only 5.4% vested in the market at these allocations. So again, it gives you a good understanding of where you are at all times in the account, and again, what are your quick conservative, moderate, and aggressive trade allocations. Now, say after a week of holding these positions, our account value has now risen to $126,000. So basically, if we're at 126 because our account has risen, and we're basically we only have $1,500 at risk right now, so it'd be 126K minus the 1500. So that would give us 124,500. So right here we'd make it 124.5, and now those are our new allocations. So again, I usually do this as each trade. Right now I'm trying to simulate a week out. And so right now 126K would be our total new equity after those trades were closed out and we made some money. But we still have one trade that has $1,500 of risk in it left. And so that gives us 124.5 as our core equity. That means that with the 1,500 at risk, we can risk 12.6. So we're only invested 12% of that current heat so far. The available heat is 11.1, and we're only 1% invested. So again, now, as a market starts to build energy for a big move, you may want to become more invested. So you may want to increase this to say 15% trade allocation or max heat allocation in terms of being able to put a little bit more at risk. And so now, say for example, we have 18.9 now as our max heat. What does it look like if we are fully invested? So at 126,000, if we put in again that 18.9 and we are fully invested, that means that we are at a core equity of 107,100. So 107,100. And what you'll see now is that down here, max heat is 8.9, current heat is 8.9, right? 18,900. That means that we are currently at 100% capacity of our max heat. We can no longer trade any more trades. The available heat is 0, and right now our total exposure is 15% at the moment of total equity. So we are 15% and fully invested. At this point, you would no longer take any trades until you close off or reduce risk exposure. So you would have to sell some portions of a position either partially. You would have to sell out your entire position or take it off the books here after you hit targets or perhaps reach losses. So again, you would have to wait until you are able to get to a point where you can add more exposure. So again, that's what it would look like right here if you are basically taking trades, updating core equity, updating total equity day by day. If you're updating your max heat, again, typically speaking, I'll stay at about 10% allocated, especially in markets where things are very quiet. And in other times, as a market starts to really behave as you expect, as it really starts to move, become perhaps a markup trend phase, and you really are confident in how the market is behaving, then you can allocate more during those times. Again, if you're feeling the market, you can allocate a little better. If there's a little bit of tension or cautiousness in the market, a little apprehension because there's impending news or perhaps some side of headline risk, then at that point you can then reduce risk exposure. So again, this is kind of a living, breathing thing that you have to kind of feel the overall moods of the market. But generally speaking, stick with the general guidelines that you've already defined for yourself, and then from experience and from different market modes and phases, you'll be able to understand when to increase and decrease leverage accordingly. All right, let's take a look here at a 5K account real quickly. Now, here's a 5K account. Say you take one trade, right? And that one trade, again, you're looking at, say it's 250 bucks. So we're taking 5K and then we're going to subtract the 250, which is the risk. And now our core equity left would be 4750, right? So 4750. And now we have one trade. We're in one trade. We're risking 25% of our available max heat. We're in 250 bucks. That's what we're risking. The available heat is 750. Say you have a really good trade opportunity that's coming up. You want to be more aggressive. You can now risk $475 on the next ones because you want to be aggressive. So from that 4750, you would now subtract 475. So 475 from 4750, and that would leave you with 4275. So here, 4275. Now you're in two trades. One is moderate, one is aggressive. You have a current heat of 725 you can now risk up to 275. So now you put on another trade, say it's moderate, that's $200. Let's just call it 200 to be even. That gives you 40.75. So let's make that a 0 right here. And now you can see that your available heat to risk now is only $75. But overall, 925 is the current heat. You have 3 positions so far. Your max heat is 1,000. That's 20% of the 5K. And your total exposure of the overall account would be 18.5 at this allocation. 92.75% of the $1,000 of max heat is at play. And so again, that's how you would basically adjust these measurements. But here, 2.5, 5, and 10, again, that is a model that I would tend to use if I had an account size that was less than 25,000, especially less than 10K, 10K or less. Again, you're going to need to put a little bit more up in order to make it happen. And again, with options trades and those types of vehicles, you can definitely risk that certain amount in order to build an account. It's a great way to build a smaller account. So this is what it would look like here from a smaller account standpoint. Over here above 25K, again, that's what it would look like from a higher account standpoint. Now, below the fold is where it gets very interesting as well. So down here is a whole nother section of the spreadsheet. So you can see here we have conservative, moderate, and aggressive risk allocations here as well. And so you can see fixed risk model, conservative, moderate, and aggressive. Let's drop this down to say 150% here. And what we're doing here basically is we're transferring this amount, these amounts down to these lines. And so you'll notice here conservative, for example, 1,071. These two are going to match. Moderate, 1606.50, 1607. You got down here 2784.60, same thing, 2785. This one's rounded, this one's not. And basically what it's saying here, if you trade day trades, for example, or even swing trades, you can then use this model. If you're trading stocks or options, this is the amount you can risk. And if you're scaling in half and half, then you can risk 535.50 on the first half and 535.50 on the second half. It's basically splitting this in half. If you want to go thirds, then you can go 357 on the first scale, 357 second, and 357 on the third. Again, it's dividing this 1071 by 3 to give you that figure. So you have a quick understanding, oh, if I'm going to trade options right now, and I'm going to go, I want to buy 3 contracts, I can buy 3 contracts at $3.57 or less. Or I can buy, say that, you know, it's $1.25 for a contract that you want to buy. Then you can buy 2 or 3 perhaps in each scale. So again, it tells you how much you can risk per scale. With the ES over here, it's showing you ticks and points. So these are your stop loss over here. That's your stop loss. So if you have 10 ticks stop loss in the ES, that's 2.5 points. You can risk 86 ticks total if you're going to risk $1,000.71, right? That means that you can risk a total of 8 contracts at that amount. Now, if you want to scale half and half, then you can risk 43 ticks on the first half, scale in, and 43 on the second. You see, 43 is times 2 would give you 86. So 86 divided by 2 is 43. 86 divided by 3 gives you 29. And so you can risk 29 ticks per scale on a 1/3 basis, 33% scaling. So it's giving you all the numbers you need. So what I do is I usually use ticks for my quick day trades or scalps, use points for kind of a longer term day trade or maybe even a swing. And so there you can kind of see how many contracts you can go. Now say you were going aggressively and you can basically put up $2,785 in terms of risk. That's the amount you're willing to risk. That's your trade allocation. And if you wanted to use, say, a 30-tick stop in crude oil, that means you can trade 9 contracts. 9 contracts at a 30-tick stop. And if you lose on that trade, you lose $2,785, your aggressive risk allocation. What if you really thought that this was going to be a swing trade and you wanted to risk, say, 75 ticks? Then you can trade three contracts, and if you lose three contracts at 75 ticks, then that's going to risk up to and no more than $2,785. So again, you can use this to help you quickly calculate how many contracts you can trade, what your stop is. Again, if I want to do something like a 35 tick stop in crude, then I know that I can trade three contracts and risk $1.07 total. So three contracts divides into $1.07 at 35 cents or less. So again, that's how you can do it each and every time. Very quick way to identify what you can trade, and again, how many contracts, what the number of ticks are, etc. So very quick way and efficient way to do this. Now, if you don't trade crude oil and instead you want to trade, say, the YM, then you would type YM right here, and then right here for the profit factor, each dollar, or each point rather, for the YM is $5. So the profit factor would be 5 in this case. So now with a profit factor of 5, over here, say you want to risk, say, 50 points in the YM over here, or say 25 ticks over here, which is also points, then you would be able to trade X amount of contracts, right? So this one doesn't trade in ticks the way it's calculated, so I would just stick with the points over here if you're doing something like YM. If you're doing, say, RTY, right, the Russell 2000, over here, this is 100 right there. Maybe that's 2 points right there, and that'll give you your risk basis for that. So again, you can add however many contracts you want to the right if you want to have them all out there. I usually just have them basically look like this, and I trade these three the most, but then I can just use my risk allocation for anything else I want to trade. Say, for example, I want to trade 2,700 contracts. I want a 25 tick stop or point stop in the YM, then I can just do the quick math that way. So again, this is a quick way for you to be able to identify your trade allocation based off of your total and core equity, and also based off of the current heat that you have at play and the available heat that you do have left to trade. So again, a great way to go. So over here, let's update this again. Say now we've made some money. Before we do that, let's go here. Let's say we've made a little bit of money, 143,000 now. We don't have any trades at play at the moment. 143,000. This is what it would look like now. You could risk 14,300. If you're averaging your moderate here, then you would be 6 positions. Again, we have all of this available exposure at the moment, right? So that's what it would look like if you don't have any trades at play. These two would be even. As soon as you put a new trade on, say we're going to put one on for 2,100 bucks, you would subtract 2,100 here. That would be what, 140. Is it 141, 900 here? And that would basically be, although that's if this is a 4. Doing wrong math here. So basically that's 2,100 if this was at 144, and now you can see 2,100 is the current heat. The available heat is here. You have 14.5% of available at play, 1.46% total exposure of the overall account. And again, this total exposure is very, very important. You don't want to be overexposed, especially in those high volatility states or major flash crash events or major aggressive bear moves. If you are over leveraged during those times, then those are events where your portfolio can really get hit very quickly. You want to be able to constantly have your thumb on the pulse of how much you have exposed. So in case those events happen, you are properly covered. Again, it's also good to mix in the type of exposure you have at risk.
sometimes having a mixture of longs to shorts, perhaps at a ratio that befits the current trend of the market, or if you're overly leveraged, for example, in one sector, again, being able to defend by hedging using ETFs on the other end would be very helpful as well. So again, various ways that you can mitigate risk in your portfolio, but this is a great way for you to have a daily thumb on the pulse of your portfolio and being able to identify and calculate various trade allocations from a conservative, moderate, and aggressive standpoint, and also being able to adjust the amount of leverage up and down as you continue to see the waves of the market more clearly. So again, a great quick way to basically calculate your trade allocations. I keep it up next to my trading machines every single day. Every trade, after I place a trade or get out of a trade, I am updating that core equity. At the end of every day, I am updating the total equity so that I understand my allocations for the upcoming day. A great way to get involved with your personal risk management and have a hands-on approach, and I believe this type of hands-on approach is the best way to really grow your account and really be involved and take responsibility for the choices and trades that you take.
And that concludes step 1, risk management, of our Swing Trade Pro 2.0 5-step swing trading blueprint. Step 1, risk management, is the first step in the entire program because it is the most important. You have to understand your own personal risk tolerance. You have to understand how to calculate your core equity, your trade allocation, what max portfolio risk you're willing to use. You have to understand how you're going to adjust your level of risk exposure for various opportunities, and you have to be able to do it all right there on the spot, on the fly, and that's why we provided that risk management matrix as well. Again, a very, very powerful step in our 5-step swing trading blueprint, and one that will continue to be very, very useful in your trading for years to come.